central banks are probably also adding euros. My guess is that the Bank of China is buying euros as it may be selling dollars, because I think they need to replace Americans as customers. And the Europeans, there's more Europeans than there are Americans. And now that the euro is at a 3-year high and soaring, the Europeans are getting richer as Americans are getting poorer. And so all those goods that China can no longer export to America, they can export those goods to Europe.
Welcome back. I'm Jeremy Szafron. Well, gold has just made history yet again. Spot prices surged past $32.50 an ounce this week, setting a new all-time high and marking the metal's strongest weekly gain since back in 2020. Now, the rally has stunned markets, vaulting gold nearly $600 year to date and signaling what many now believe is a systemic and seismic shift in global capital flows. And at the same time, the U.S.-China trade war is spiraling. President Donald Trump's 145% tariffs on Chinese imports triggered full retaliation from Beijing, which has now raised its own duties to 125% and accused the U.S. of economic coercion. But the deeper fear is inside the U.S. Treasury market, traditionally the cornerstone of financial stability here within the global markets. And despite market turmoil, yields remain elevated and volatility in sovereign debt is now being compared to risk assets. Now, with treasuries, the dollar, the U.S. equities all falling at once, some are warning that the traditional flight to safety dynamic is breaking down. Before we get onto the economic outlook, I want to talk about gold here for a second, because, this price action has been wild to watch. We're seeing this massive move rising nearly $600 this year alone. We know some of the basic major drivers. Obviously, we covered extensively here, central banks, what have you. But what's behind this surge here? What do you think is going to be the next year here in the gold market?
Well, gold's up over $250 in the last 3 days.
Yeah.
Right. So we're accelerating. Last couple of days, we were $100 a day, and maybe we'll be up again. Maybe we'll be up another 100 by the time, they close today's trading. But what's happening, and what I've been telling people was happening all last year, as the price of gold went from 2,000 to 3,000, and nobody cared, and nobody was buying it because everybody was, sidetracked by Bitcoin and all the talk about digital gold. Nobody but foreign central banks were buying actual gold. And the reason they're buying gold is because they're getting rid of their dollars. They are preparing for a world where the dollar is no longer the center of the monetary system, where it's no longer the reserve currency. And so if you're going to get rid of dollars, what do you replace it with? Well, gold is the most likely alternative to the dollar. And that's what they've been doing. Although I think recently central banks are probably also adding euros. My guess is that the Bank of China is buying euros as it may be selling dollars, because I think they need to replace Americans as customers. And the Europeans, there's more Europeans than there are Americans. And now that the euro is at a 3-year high and soaring, the Europeans are getting richer as Americans are getting poorer. And so all those goods that China can no longer export to America, they can export those goods to Europe. And as a matter of fact, China is not going to be importing any more goods from America. And so they're going to import a lot of the agricultural products or other raw materials that they used to get from us. They're going to import them from South America. And so now those countries are going to be richer because they're going to have more export earnings. And now they're going to be able to afford the goods that China is no longer shipping to America.
You're watching this, you got this data coming in, and you're watching your treasury market. What's the pivot?
Well, the Fed needs to raise rates. That's what they're supposed to do. But they're not going to do that. Yeah. There's no way they should cut. They never should have cut. They never should have stopped hiking. The Fed never got into restrictive mode. That was a lie, because credit continued to grow to record levels in the government, in the private sector. That meant that credit was too loose. The Fed never had tight money. Also, look at the price of gold. When Alan Greenspan was Fed chairman, he said that he used gold as a way to tell whether he was too loose or too tight. And he said that if gold got up near $400 an ounce, that meant that he was too loose. And if it got down near 300, that meant he was too tight. Now, obviously, at the time, it was trading at around 350, right? So he was looking at gold as an indicator of whether or not he had the correct monetary policy. Well, Powell watched gold go from 2,000 to 3,000 and cut rates. What was that telling you? Gold was telling Powell that he was making a mistake, that rates needed to be higher. But the reason he's cutting rates is because we're insolvent and we can't afford higher rates. But so I think the Fed is eventually going to cut rates and go back to QE. But they're waiting for everything to collapse, right? Because they don't even know that it's going to collapse. But they're waiting for some signs that the financial system is buckled. Maybe they want to see big layoffs, which are coming. We're going to have widespread layoffs in the United States because the whole service sector economy is going to shut down because all the imports are going to be cut off. So we got nothing to buy. So, all these businesses are going to be going into bankruptcy and laying people off. But when the Fed cuts and goes back to QE, that sends inflation through the roof. So it's high and it's going to be a lot higher. And then it sends the dollar through the floor, and it's actually going to send long-term interest rates higher.
Interesting.
So, we're at the end of the road here.
Hey, get back to that Treasury market conversation here, too, because, it's sending a lot of worrisome signals for the U.S. and the rest of the financial world. China is holding the second largest stockpile of U.S. Treasury bonds. Analysts, investors, again, we're getting into that question whether or not Beijing might start offloading in response to these tariffs. You were just talking about Europe, too. If this happens, what impact could it have on the U.S. and global financial systems?
Well, I think that there is going to be a massive loss of confidence because it's been a confidence game the entire time. But look, this is going to be a financial crisis much worse than 2008, but it's not going to be global. It is a U.S. crisis. It's not a global crisis. It's actually liberation for the rest of the world because they're going to be liberated from the burden of supporting the U.S. economy. That means more for them. We've been living above our means. Well, that's only possible because the rest of the world has lived beneath their means. Well, they don't have to do that anymore. They don't have to produce stuff for Americans anymore. They don't have to loan their savings to America. They don't have to invest in the U.S. financial markets. They can invest in their own markets. They can consume their own goods, right? They can invest their own savings. So our loss is their gain. And so this is going to be a global boom. It's like a giant weight has been removed from them. And now the global economy can be a lot stronger without having to drag the U.S. consumer behind.